everybody, and welcome. My name is Andi Last. I'm the media manager at Pure Financial Advisors and producer of the Your Money, Your Wealth radio show and podcast. Thank you for joining us for this live webinar with Joe Anderson, CFP, and Big Al Clopine, CPA, the hosts of Your Money, Your Wealth. I'll be managing any questions that you have for Joe and Al today, so type them into the chat box as you think of them, and Joe and Al will answer them as they are able at the end of the webinar or along the way. I'll send you a chat message right now so that you can see where that chat is. If you're on a desktop computer, chat is on the right side of your screen. And if you're watching this on a phone, you'll see chat down there at the bottom. Today's webinar, of course, is presented by Pure Financial Advisors, a financial planning firm headquartered in Southern California. Pure Financial is entrusted by our clients with over $2 billion in assets under management and was ranked among the top registered investment advisors in the nation in 2019 by RIA Channel and Smart Asset. Pure Financial is also one of the nation's fastest growing private companies on the 2019 Inc. 5000. Alan Clopine, CPA. He's the CEO and CFO of Pure Financial Advisors. He's provided tax planning services for individuals, corporations, and trusts for over 30 years while running multiple companies. And Joe Anderson, CFP, of course, is the president of Pure Financial Advisors. He's been helping people with their finances since the late 1990s. He's been ranked by Forbes among the best in-state wealth advisors in California multiple years running. And this year, he was ranked number 3 out of 80 advisors on the list in Southern California. Now, please welcome your hosts for today's live YMYW webinar, Joe Anderson, CFP, and Big Al Clopine, CPA. Hello, Joe and Big Al. Are you with me?
We are, and wow, what an introduction. I mean, Joe, we sound important after listening to that.
I didn't listen to a word you said.
You never did.
That's par for the course.
I just popped in. So, well, yeah, we decided to do this one more time. We had a huge response. What did we do this about a month ago, 3 weeks ago?
Yeah, 2 weeks ago. Time flies.
It feels like weeks turned into months and months turned into years, but now it's kind of reverting back a little bit. Things are opening up and things are moving. So what are we at? June 10th. Well, here we're all still working remotely, but I think California opened it up a little bit. Starting when, Al? Maybe in the next couple of weeks?
Well, it's been gradual. So this week, gyms open up, bars open up. So we're getting a few things back.
So you're going to go to the gym and I'm going to go to the bar?
That's what I'm thinking. That's what I'm thinking.
Got it.
That's why I threw one in for you.
Everything else, those are the only two that really matter, right?
That's right.
Oh, boy. All right. Well, a couple of things. If you guys got questions, use the chat. This is really for you. Al and I have been doing the radio show and podcast and TV show now for many years. I think we're going on 13, 14 years, something like that, on and off, I think, with the radio show. We're starting season 6 with Your Money, Your Wealth TV. We're going to air that this week. So if you're not familiar with the TV show, you can go to YouTube or our website, Your Money, Your Wealth, and check out the episodes there. So we're getting those back up and running. So it's exciting. So hopefully the summer is great and the fall is even better. So, but if you do have money questions in regards to the CARES Act, I have a small deck. I know some of you were on the call a couple of weeks ago. I don't want to bore you with that stuff, but sometimes it sparks some questions in regards to getting people wound up a little bit. But if you do have questions to start the show, by all means, just throw them out there and we can kind of go from there. Al, you got anything to add?
No, I think I'm ready to get started.
Cool.
Well, you already have a couple of questions, so we can either start right off with those, or do you want to do the deck first, or how do you want to do it? These people are jamming. They're ready to go, Joe.
Well, you know what? Give me 10 minutes, 5 minutes, because I just want to hit on the biggest questions we get are based on the coronavirus distribution, so the CRDs, and then also the delayment of or the required minimum distributions. But I think also there's the Secure Act too that we have to talk about, because that pushed required minimum distributions to age 72, and then it also got rid of the stretch IRA. And so if you've listened to us at all, you understand that we're big components of tax diversification. And right now, if you look at taxes themselves, they're pretty low. Well, why don't we do a poll, Andy? Let's see who the heck's on this call. Let's see who's retired, not retired. Let's see let's see that.
All right, so there's a poll on screen now that asks how close you are to retirement. Are you already retired less than 5 years, 5 to 10 years, 10 plus years, or uncertain, which under the circumstances is perfectly reasonable. So there's a little bit of a delay between when I say it and when you hear it. So I'm going to give this a few more seconds for you to fill in your answers there. So we're going to take the poll down in 5, 4, 3, 2. I'll give you a couple more seconds here. Right now, we're at 30% are already retired, 21% are less than 5 years, 24% 5 to 10, 16% are 10 plus years, and 3% are uncertain. And I'm going to close that poll right now.
Did you get all that out?
Yeah, I was. It's all up here. It's right in the head.
So you're kind of equal between already retired, less than 5 years to retirement, 5 to 10 years to retirement. So that's the majority of your folks. I
thought you said 31% already retired. That sounds like a third.
Well, now it's 29% already retired, 25% less than 5 years,
Oh,
22, 5 to 10. Yeah.
Got it. Okay.
Got it. Thank you. All right.
Sure.
So half and half. We'll just call it. We'll call it good. Let's
I
talk
like to be
taxes.
very precise.
Yes. Let's talk taxes. Let's see kind of where people think that tax rates are going to go.
All right, so I'm publishing another poll now. What do you think is going to happen to tax rates in the future? Are they going to go up? Are they going to go down? Are they going to stay the same? Or you don't know? And if you've been listening to Your Money, Your Wealth, you probably have a pretty good idea, but answers could be all over the place, and who knows what's going to happen in the future. So once again, I'll close this up in 5, 4, 3, 2, give it a couple more seconds. And wow, 92% of people say taxes are going up, and 7% don't know.
Okay. All right. So I think, Al, you and I are probably in the same camp there. We don't know, or what we believe is probably going to be up.
Yeah, I think, Joe, in the short term, probably there's not going to be much change. But in the long term, it certainly seems like taxes are going to be going up, given our national debt.
Okay. Well, let me do this. Let me just go through a couple of quick slides, and we'll switch it back to their questions. Well, Andy, you can interrupt me if we get too many. I don't want to draw this thing out for hours. Let's just kind of go 30, 45 minutes. And if people got questions or they keep piling in, we can stick around.
You got it.
But I want to get really good information out to all of you. And the CARES Act is the newest bill that was signed right in March. We have the Secure Act that was signed in December, and then the Tax Cuts and Jobs Act that was signed a few years back. So if you take a look at these three acts, it's been kind of busy there with the good old IRS and Congress putting out different laws. And a lot of it has to do with your overall retirement account. So let's just say 30, 40% of you that are currently retired that do have retirement accounts, your strategy might look a little bit different than maybe someone that is 25 or 30 years from retirement. So understanding how these laws work, really the most important piece of this is that we can explain, here's the law, but then how do you apply it? What does it mean? What do I do with this, right? Can I benefit myself or my family from any of the new things that are coming out? So we talked about recovery rebates. You probably already heard of these recovery rebates, but one thing that I want to talk about, this is the stimulus checks that most of us received already. However, this is a 2020 tax credit. So if you did not receive a rebate, you still may be able to or eligible to receive that rebate because it's a tax credit on your 2020 tax return. They just sent out checks a little bit early and they looked at whatever tax return was on file. So if your adjusted gross income in the year 2020 is under $150,000 for married or $75,000 for single, you will still get the $1,200 tax credit if you're single, or $2,400 married, plus another $500 per child. So just FYI, as you're doing your planning this year, if you're close to those marks and you didn't receive that rebate last year, maybe you were furloughed, laid off, reduced hours, whatever the case may be, you still might be able to benefit from those rebates. Unemployment, not going to talk too much here, but we've seen the numbers. Last Friday, the market enjoyed those numbers. And I think the big reason why there might be a little bit confusion is that they gave employers really two options. They said, hey, keep all your employees on staff, and then you can take a loan from us and we can potentially forgive that loan as long as you keep your employees employed. Or why don't you lay off most of your employees, and we're going to do something a little bit different with unemployment compensation by eliminating the waiting period. We're going to give them a $600 a week kicker for the first 4 months. And so hopefully that makes a lot of these people whole. Plus, self-employed individuals will also be eligible for unemployment comp that they were never eligible before. So we have a lot of self-employed individuals that were out of work because the whole, economy shut down. So it was a small-term shutdown, and they're like, oh, when we reopen, right? Hopefully this is kind of a short-term fix. So that's what they basically did. And so most people were like, all right, well, I'm just gonna hopefully furlough me, right? I want to be laid off because their compensation, in some cases, were paid higher. Of course, not all, and a lot of people will lose their jobs and not go back to work, which is really scary and sad. But we're seeing a lot more people that are going back to work, as you saw the unemployment numbers last Friday, and then the market almost went back to square one. So if you would have asked Al and I or Andy or anyone at our firm, we're on June 10th, back in March or April, right? When is that? Hey, in a couple of months, the market is going to be exactly where it was, or reach the Nasdaq, reach more all-time highs. We'd be like, you're crazy, right? We think that the market will probably drop another 50%. We're still not out of the woods. Who knows what's going to happen over the fall? So still be very tactical in regards to what you're doing, right? Make sure that you have an investment strategy and plan, and we can answer those questions. But I think more importantly, if you have a tax strategy where you can eliminate some of the taxes long-term, you don't have to take on a lot of risk because you're saving it on the tax side of it. The PPP program, this is when employers said, I'm going to keep my employees out. I'm just going to take a loan. It was $10 million or 2.5 times average monthly payroll. When you look at taxes, right? So let's go here, because a lot of this is going to be geared towards taxes, and you want to understand what your taxable income is. And so depending on when you filed, it was line 43, then they moved it to line 10, and then I think this year it's line, what is it, Al? Taxable income, do you know off the top of your head right now?
No, but it's around 16, give or take.
Give or take. So
Yeah.
they're changing the formats of these tax returns. So understanding your taxable income is really important to determine what type of planning is appropriate for you. And so here's where the brackets are right now. So that you got a 10%, 12, 22, 24, 32, 35, and 37. So these are slated to go up already due to the Jobs Act. So they sunset on the individual side in 2025. So starting 2026, these rates go up. And if you look at this 12% rate is going to go to 15%, right? 22 is going to 25. 24 is going to 28, right? 32 is going to 33, 35 stays the same, and 37 is going to 39.6. So what we look at is this kind of zone here, is that this is kind of the go zone in regards to tax planning, because this 24% tax bracket is now $326,000. The thing's huge. They widen the gaps on these things. It's giant. Before, if you made this type of income just a few years ago, you were probably an alternative minimum tax, and your effective rate was 35%. So tax rates relative to history in just a few years ago are almost at all-time lows. And so that's why we want to make sure that we get information out and say, hey, what makes sense for you? If you understand these tax brackets, that if you have a retirement account, you're going to be taxed regardless. What tax rate would you want to pay it at? 12% or 15, 22, right? Or 25, 24, 28. So maneuvering your assets in such a way to make sure that you're tax efficient is really a mantra of ours, in our goal in regards to educating you to make really good financial moves. Because the corona-related distribution, CRDs, this is something that's interesting because you can take $100,000 out of your retirement account. So if you have $100,000 in your retirement account, you can take a distribution from that overall account. There's no taxes, there's no penalties up front. If you're under 59 and a half, you can take the money out. But you have to be eligible, and the eligibility is that you were diagnosed, or a dependent or spouse was diagnosed, you experience any type of financial consequence, adverse financial consequence, quarantine, furloughed, laid off, reduced hours, small business owner, maybe you had to shut down, right? Self-employed, couldn't work, looking at childcare, or whatever, any other reasons that the IRS deems okay. So that's a lot of people. a lot of people will qualify for these CRDs. So it allows an individual or couple to take $100,000 out of the retirement account, reduce any type of or early withdrawal penalty, not subject to the 20% mandatory withholding, but then what you have the ability to pay the tax over a 3-year time period. So if I take $100,000, or in this example here on the slide, it's $90,000, you can put $30,000 of taxable income on your return this year, 30 next, 30 the following. Pretty big deal to keep you in those lower brackets that we just went through, right? So now I get a large chunk of my retirement account outside. I can put it into a brokerage account and then have it more tax effective or tax efficient, if you will, how I'm investing that, more liquidity, right? Get it out of the shell of the retirement account. And then if I need it, right, I'm going to be tax favored from it. For some people that are a little bit younger that want to take the money out, put it in a brokerage account, you have 3 years to pay it back. So as long as the distribution was made in 2020, you pay it back over a 3-year time period. There's no taxes, there's no penalties at all. So it's like the 60-day rollover rule, right? You get 60 days to put it back. This is a 3-year rollover rule. So no taxes, no penalties. When you do that, and you have 3 years. Now, there's some nuances if you wanted to wait for the 3rd year, 2nd year to pay it back, just because of how taxes are filed, and we can get into that if you have specific questions here. Another big thing with retirement accounts is the waived RMD, so you do not have to take a required minimum distribution this year. If you've already taken the RMD, you can replace it if you want to, depending on when you take the RMD. If you took it in January, you have to keep it, but anytime after that, you can put it back. Should you put it back is another question. Like we talked about, and 90-some-odd% of you feel that tax rates are going to go up. And if you have a lot of money in a retirement account, it might make sense to start bleeding some of these dollars out at these lower rates. If you haven't taken your RMD, it still might make sense to take the RMD, but then you could potentially convert it into a Roth IRA. So the CRDs and the waived RMDs are two really big things that they came about within the CARES Act for individuals, especially looking at retirement. So here again are the tax brackets. So it's just identifying a little bit of where you fall here is going to determine what type of planning that's going to be appropriate for you. So let's stop there. What did I do that in 10 minutes or so? And let's kind of open it up. I would imagine there's a few different questions here.
We got questions all over the place. I'll start with the one related to stimulus. Stephen asks, if I received a $1,200 stimulus check, but my AGI will be over $150K for 2020, what happens?
You go to jail.
You better
Sorry,
pay
Stephen.
that back right away. No, nothing happens. Yeah, there's no clawback on this, so it works out pretty good for you.
All right. Kevin says, can you speak a little on bonds? Treasury versus total bond index, short-term versus intermediate, long, recommendations on bond mix for a 10-year pre-retirement portfolio.
Yeah, that was pretty quick. Hey, can you speak about bonds? Florida, like what? Treasuries versus what?
Treasury versus total bond index, short-term versus intermediate versus long, and recommendations on a bond mix for a 10-year pre-retirement portfolio.
Okay, all right. So there's a few different things. There's talking about a packaged product, such as like maybe an index fund in regards to an aggregate bond fund versus individual bonds. So there's pros and cons there. I guess we can start there. A bond is a loan, right? So if we go really elementary here, is that you're lending your money to a certain organization, a company, or actually the government. So you're giving them a loan and they're paying you an interest payment for a certain period of years. So it's a 1 year, 3 year, 5 year, 10 year, whatever it is. So they take that money, they do what they want with it. They're paying you an interest payment, and at the end of the term of the loan, you get your money back. So when you start analyzing loans, people look at it as stocks. They're looking at past returns and things like that. You don't want to do that because a stock, you're participating in the profitability of an organization. You're receiving capital appreciation of that company or dividends, right? Or both in most cases. So what types of bonds should you own is all going to depend upon, how much money that you have, what's the demand for the portfolio, and truly is it in a qualified account or non-qualified account? What I mean by that is it in a retirement account or non-retirement? Our belief is that you don't want to take a lot of risks in bonds. Bonds should be there to buffer, right, the overall portfolio's volatility. Unless you have a lot of money that is non-qualified and you're very risk adverse, then maybe we would look at a bond ladder in regards to municipal bonds to get you tax-free income or something like that. But in general senses, you have a 10-year time frame. Would you rather go individual bonds and build a bond ladder versus a bond fund? We would probably go bond fund, right? Unless you have millions, because the spread on bonds is crazy. There's very little transparency in the bond market, and they don't want to deal with small potatoes. And what I mean by small potatoes is that if you got less than 10 million bucks, the bond traders will take advantage of you. If you buy a bond fund, you're going to get a steep discount. They're very cheap and inexpensive. So I'd much rather go a bond fund. Would you want to go intermediate, long, or short? Well, I think in our opinion, we'd rather keep it safe. Go short, right? Very high quality, so you're not going to see a lot of variability there, but you're also not going to see a lot of income. So I don't want to take a lot of risk in my bonds. I would much rather take risks in the overall stock market. So then it really depends on what your target rate of return is, or what's the goal for the portfolio. How much money do you actually need to make to determine how much money you should have in bonds versus stocks? So I kind of rambled there a little bit, but does that make sense? I mean, Al, you got anything to add?
Yeah, no, that's a lot of good information. I would add Treasury bonds are generally tax-free in the state that you're in, at least in California, and I think many other states. Municipal bonds in your own state are going to be tax-free federal and state, so that's something else to consider. But I would agree with you. I think the average person would do better with a bond fund, and shorter term than as compared to longer term, higher quality as compared to lesser quality. Because when you look at the studies, the extra risk that you take for bonds, you get a little bit more return, but not much more. Whereas in stocks, the risk you take there, over the long term, you can end up getting a lot better return.
Yeah, the risk return relationships with bonds, the more risk that you take, you don't really get an equivalent amount of return for the more risk. And I guess to say it this way, how do you lose money in a bond is that if interest rates go up, in most cases, bond prices go down. Well, where are interest rates right now? Right? They're super low, right? So then it's like, okay, well, do I want to go longer term to try to get an extra yield, right, on my bonds? Well, if interest rates go up, it's like almost a guaranteed loss, right? So you want to keep that short, high quality, I think, in today's environment where interest rates are at, right? You can hold a bond to maturity. You will get your money back as long as there's not a default, right? So there's interest rate risk, and then there's term risk, or there's default risk. So then it's looking at the credit quality of the company. You want to go a Treasury. Well, is the U.S. going to file bankruptcy? I don't know. If they put another $3 trillion of stimulus, right? So it's just understanding the mechanics of it and understanding the risks that you're taking with your investments. And if you understand those risks, then do whatever you want. But don't be surprised if something happens. Then that's when you make rash decisions. It's like, what the hell? Why did this just happen? Because you didn't understand what you were investing in. But if you understand the pros and cons of each investment that you're in, when things move in the markets, right, then you basically hold course. You stick with your overall plan and strategy because you understand it more. You have more confidence, I guess.
Yeah, and I would just say, so Treasury bonds are generally considered the safest because they're backed by the government. They are a government bond. And as far as our government going bankrupt, since they print their own money, they're probably not going to go bankrupt. See, most companies don't print their own money. That's why there's an issue there. Something else to consider is Treasury inflated protected securities, which are also government bonds, but the interest rate is indexed based upon the inflation rate. Now, these are more volatile than most other types of bonds, so I wouldn't invest a lot in those, but you might want to consider 5 or 10% of your bond portfolio on something like that.
Okay, our friend Len actually has a related question, so I'll just see if you've got anything else to add. He says, any recommendations for the fixed income portion of a retirement portfolio besides short-term treasuries and tips, considering low interest rates? In my case, the fixed income portion is all in a traditional IRA and won't be touched until RMDs 5 years from now.
Well, yeah, I think we covered that. I think the bonds that just understand that when interest rates go up, in most cases, bond prices go down. So we shortened up our bonds and our portfolios here. We managed $2.5 billion because there's that risk-return relationship. It's like you try to go out, right, to get a little bit more yield. It's not, who knows? I don't know. I don't have a crystal ball, but we didn't see the risk of doing that was going to pay off for our clients' advantage.
Yeah, and sometimes people ask, well, shouldn't I just invest in a cash or a CD, something like that, because it's not going to go down in value? And I think over the long term, you'll find that shorter term bond funds will do better. Even though there might be a short term reduction in value, what happens is as these bonds mature inside that mutual fund, then they get reinvested with better interest rates. So you end up doing better than a CD over the long term, although day in and day out, you might see a little bit of fluctuation. Not much, but a little.
Okay, Randy says, what would be the strategy if your jumbo CD, 25K plus, is now renewable at lower rates? At this time, what would be the best strategy with that money that is now available?
You put it in a globally diversified portfolio based on your goals.
All right. Keith says, our COVID disaster advance for our short-term rental finally came, but indicates a 3.5% interest rate with payments starting in 12 months. Our understanding was that the loan was to be forgiven, but there is no indication of that being the case. Any input?
We'd probably need a little bit more information. So what is it? What's he?
It's a rental property he got a loan on? Is that what you're reading in?
He's got a COVID disaster advance on our short-term rental finally came in. It could be forgiven depending on how we would. Keith, email me personally. Just give me more information. It's just too vague, and I could do some research for you and tell you exactly what's going on there.
Yeah, part of the problem is there's so many different loans out there. It's hard to keep track of every single one.
And then people call them different things that are not necessarily familiar with the loan programs. So you could be calling it something else. So just send me a little bit more information. Just email me and I can help you.
So Keith, that email is info@purefinancial.com. Paul says, I've been furloughed and my company is allowing me to take a corona-related distribution withdrawal. I don't need the funds, but want to roll over to my IRA out of my 401k. Yay or nay?
Well, the benefit is, yeah, I mean, it doesn't necessarily matter. So if you don't like your 401k plan, you can take a corona-related distribution, a CRD, pull it out of your 401k plan, and then just repay yourself into an IRA. There's pros and cons. If you have a 401k, depending on your occupation, right? So maybe if you're high risk, there's some better ERISA protection within an overall 401k plan than there is IRAs, depending on if you were sued and if you file bankruptcy. There's so different things in regards to like liability protection with IRAs and 401k. So that's one thing to consider. You have to look at the fees associated with the 401k versus the fees associated with an IRA that you would potentially want to invest in. Like what's the mutual funds or stocks or bonds that you would want to check or invest in. If you retire early at age 55, you have full access to the money from a 401k plan. If you have an IRA, then it's 59 and a half. If you're still working at 72 years of age, and I have a 401k plan, I do not have to take a required minimum distribution from the 401k plan as long as I'm an active participant in that plan. If I have an IRA, I have to take an RMD. So you have to look at that. But with an IRA, you have a lot more flexibility. You can invest in anything that you want. You can still buy funds and investments that are very low cost, very efficient in regards to, very similar potentially to your 401k plan. If you're looking to do conversions or things like that to be more tax diversified, IRA is a lot easier to do it that way. So there's pros and cons. You just got to weigh those things out to see what's best for you.
Yeah, another option besides rolling into an IRA is just taking the money out and keeping it in your non-retirement or non-qualified account, because then you've got 3 years to pay the tax. So you can pay it slowly over time while rates are lower, and then you can add to some tax diversification, meaning that many of you have most of your dollars in retirement accounts. So to get some money outside of retirement that would be subject to future capital gains is a better, lower rate. So that's something else to think about too.
Yeah. Looking at how much money you have in a 401k plan versus non-401k money versus Roth money is kind of the first step to see how diversified you are from a tax perspective when you start taking income from that portfolio. So, and then it's looking at, well, if we're talking a couple 100,000, it's probably not going to mean much. But if you're now several 100,000, growing to millions, then that's when we would suggest diversifying out.
Yeah, sometimes too, Joe, is when people want to do Roth conversions and they don't have any money outside of their retirement accounts, this would be a good way to get money out. So you can pay for the tax on your future year, even current year Roth conversions.
Right.
Mark, these two questions are actually related, and I think you kind of covered them in the opening. Mark says, so I can still take a CRD anytime before the end of the year, even if I go back to work this month?
Correct. So, Mark, if you want to take a Corona-related distribution, again, anytime this year, the deadline is December 31st. So you go back to work next week, you can still take up to $100,000 out of your retirement account. You can put it into a brokerage account like Al was talking about, or you can reinvest it into an IRA, or pay your 401k back, whatever that you want to do. You have 3 years to pay yourself back, or you have 3 years to pay the tax. So you can do that anytime this year up to December 31st.
Jay says, if you take the money out of the 401k due to COVID, is it possible to put the money back in the next few years when working again? Another one you covered already.
Yeah, 3 years. So you have 3 years to put it back until the end of 2023.
Yeah, here's something to think about, though, and that is you do have 3 years to replace it, but you have to pay taxes on a third of it this year, a third of it next year, and a third of it the following year. So if you replace it by year 3, you might have already paid taxes for those first 2 years, so you're going to have to file an amended return to get that money back.
Okay, Matthew says, instead of selling to rebalance my asset allocation, I just change where new money is going in. Any issues with that?
That, to me, that's the best way to rebalance, because then you don't have any tax consequences. So if you have new money coming in and you can stay with your prescribed allocation, then that's a great way to go.
Yeah, I guess it depends on how much money that's coming in, and how much money that you're saving, and what the overall total portfolio is, and what your rebalance bands are. So, right. So what he's saying is that, let's say you have a 20% allocation to large companies, and you have a band of 20% or something like that. So if it goes up 4% or down 4%, right, then that's when you would make an adjustment in regards to rebalance. So $4,000 on either side of the transaction. So if it's down $4,000, then you save $4,000 instead of rebalancing, selling something and refilling it. You're just buying that asset class while it's down. Yeah, that makes sense, because as Al said, you're not selling assets that are up, buying that are low, that could potentially create tax, but you still want to buy the asset class while it's low. So if you do have new monies coming in to rebalance, but I just, in a lot of cases, you don't see enough money coming in to have a full rebalance. For instance, back just in April, we made hundreds of millions of dollars of trades that were buying stocks, right? Where a lot of people were doing the opposite. They were getting out of stocks and going into bonds. When the market dropped 30%, we have triggers and bands on our portfolios. It says, all right, once they get to a certain band, it's not a time frame, but as soon as that thing triggers, right, we're either selling or buying to make sure that we get that risk parameter just right. So when the markets are falling, we're buying stocks, right, at that time frame. So for you, it's like, okay, well, I got new monies coming in. When is that new money going to come in? Is it once a year? Is it once a month? Is it once a quarter? So the market might be right down. You don't have the money to put it in when you should be rebalancing. And then the market goes back up and you're back in balance. And then now you're going to deposit some funds. And so when you're, because our markets, the client's portfolios will recover that much quicker when you have the right rebalancing strategy, just because you're buying more shares of stock. When most people are freaking out, if it's automated, right, you're going to do much better that way.
Yeah, I think that's a good point, Joe, because it depends how often and how much that you're putting back into or reinvesting in your portfolio, because you probably, as an individual, want to be rebalancing at least once a quarter. Now, we actually check this daily, and we rebalance client accounts every single day, depending upon this 20% band that Joe is talking about. But yeah, if another consideration too is I mentioned taxes. Now, if you're rebalancing inside a retirement account, it doesn't matter. There are no taxes, so you don't even have to worry about that component.
And maybe that's what he's talking about with his 401k plan on a bi-weekly basis then.
Yeah, maybe so.
I'm just going to throw in a quick comment here from Randy. He says, by the way, these guys are world famous. I'm listening from Saudi Arabia.
Saudi Arabia? The hell are
Thank you, Randy.
That's awesome.
Just a reminder, folks, if you do have questions, it's type them into the chat and we'll get to them right now. David asks, does a conversion from traditional IRA to Roth count in the income calculation that determines eligibility to contribute new money to the Roth? In other words, is the Roth conversion included in MAGI?
The answer is no. And that's kind of a neat thing about Roth conversions is it doesn't affect your ability to do a Roth contribution. So that conversion income is not included in the MAGI, modified adjusted gross income, to figure if you qualify to do a Roth contribution.
That's all we got.
Oh, well, Joe, I got something. I got to correct myself. Taxable income 2019 is line 11B. So
11B.
Not 16, 11B.
Okay.
So when you're trying to figure out your Roth conversions, go to your 2019 return, see what your line 11B looks like to figure out your taxable income. Go back to that chart that Joe showed us, which is married filing joint or single filing, or single filing if that's what you are. Take a look at what your taxable income is relative to your current bracket and see how much room you have in that bracket to do a Roth conversion for 2020. You may want to do that given that we have low rates. But remember, if you do a conversion this year and your income was higher in 2018 and 19 and you didn't qualify for the stimulus payment, a conversion in 2020 may put you also in a high income bracket where you don't qualify. So just be aware of that.
So this is what we're looking at here, right? So this 10%, 12, 22, 24, 32. So Al's like, all right, well, look at line 11B to figure out exactly where you fall. And then that's going to determine a few things because, right, we talked about a CRD, we talked about RMDs, we talked about, bonds, but what the hell, I'll draw it out again. So you got tax-free dollars, you got taxable dollars, and you got tax-deferred dollars. So the tax-free would be your Roth IRA, Roth 401k, or this is not your non-qualified, so mutual funds or real estate. And then this is your retirement accounts, IRAs, 401ks, 403bs. It could be your pension plan. Even Social Security kind of falls in here because it's taxed at ordinary income rates. So when you have dollars here, when you take these dollars out, you're never taxed ever again. It's 0%. When you have assets here, you're taxed at 15% or 0 or 20. But regardless, it's always going to be less than this, which is going to be ordinary income. The reason why I say that is that if you're in the 10 or 12% tax bracket, then your capital gains is 0. So your ordinary income bracket is 10 or 12%. Cap gains is going to be 0, right? So anything on top of that, you're going to be at 15%, which is going to be a lot lower than 22, 28, 24, so on and so forth. So that's why we're saying with the CRD, if you have dollars here, it's going to be taxed at ordinary income rates. These rates are going up. We know this. So does it make sense to start depleting some of these dollars? With the CRD allows you to do $100,000 to move it here, right? And pay 33.3 of income showing on your tax return for the next 3 years. So then you go back to the tax tables to see where you fall. Can you keep yourself in, let's say, the 22% tax bracket, the 12% tax bracket, right? 24, whatever, because those rates are going up. And where do you, they might even go a lot higher. We're in the lowest tax environment in the history, right? So that's why we're looking here. With required minimum distributions, is that you don't have to take it. We're thinking, take it, but put it up here. Move it into a Roth IRA. You pay the tax, but I'd gladly pay that tax all day, right? It's cheap money. I want to buy my partnership back from the IRS at low rates, almost all-time low. So I'm going to buy that tax and then have all future growth go up here. So then I look at line 11B and then look at whatever room that I have. Say I'm married, my taxable income is 60 grand. I want to say, all right, 12%. I'm going to go to the top of the 12% tax bracket. That's $20,000. I'm going to move $20,000 right into this tax-free account. That $20,000 is going to grow to $40,000. I pull the money out. I never pay tax ever again, ever. There is no required minimum distribution in the Roth. There is a required distribution here. Why do they have RMDs? Because they want all this money out to get their tax. Well, if I got it out here, I sheltered it. And then now all future growth is going to grow tax-free for my life, spouse's life, kid's life, whatever, okay? So there's strategy that you have to think of in regards to Roth. Now, hey, Andy, throw up that poll. Let's see, how many people have a Roth? Am I the only one here now?
No, I was putting the poll up. So there is a poll up now. Do you have a Roth IRA? Yes, no, or what is a Roth IRA? So let us know what your answer is to that. And I'll leave that up for just a couple of seconds here. So far, we got 7% that do not have a Roth. Nobody has said what is a Roth IRA yet. So these are listeners to Your Money, Your Wealth. Everybody seems to know at least what one is. All right, so I'm going to close this up in 5, 4, 3, 2, 1. 91% of the Your Money, Your Wealth live webinar attendees do have a Roth IRA. 8% do not. Nobody doesn't know what it is.
All right, so then most of you are then familiar because we do these cold. Andy and I do. We do a lot of them trying to educate the public, and it's amazing to me that it's usually 60 or 70% of people out there do not have a Roth IRA or don't even know what it is. I'm glad you guys are educated because I think this is the best gift that the IRS has ever given us because all future growth is going to grow tax-free, right? There's two ways to get money up here. You can do contributions, $7,000 if you're over 50, $6,000 if you're under, as long as you qualify from an adjusted gross income standpoint. So if it's under $200,000 of AGI, married, but 140 single, you're good to go here. Another way to do it is move it from here. That's a conversion. It's taking existing dollars from a retirement account and then converting it into the Roth. You pay the tax, but never, ever again, okay? Because then when it comes time to start taking distributions, you have your choice. And the CARES Act gave some of us some opportunity to say, do I want to be a little bit more diversified to see where my dollars are so that when it comes time for me to start taking income or passing it to the next generation or whatever your true goals are, right? You can pay a lot less in tax and then give those to the heirs.
All right, we have gotten a rush of questions come in, so we'll go through those now. Todd says, on a scale from 1 to 10, how likely are legislators to change the law to make some portion of the Roth growth taxable?
Let me explain it this way. A few things. I got two comments for you. What's his name?
Todd.
Todd. Okay, Todd, if I were to ask our audience here, is that, Al, how much money's in retirement accounts? $24 trillion, something like that, 25 trillion?
Yeah, it's around 20 probably.
Well, okay, we'll call it 20. It's more than that, but 20. That's a big number, right?
Then why'd you ask me?
Because I was going to say something like 50.
Okay.
$20 trillion, 24, 25 trillion, something like that, sitting in these retirement accounts. And those are mostly owned by the baby boomers. Now, this is just coming from Joe Anderson, right? This is, take that as a grain of salt. All right, so there's so much money here. How much money do you think is in Roth IRAs? If you exclude the few hundred people on this call, all of you, we're not going to count your Roth IRAs. The rest of the public, how much money is in Roths? You got it. It's like $10. It's not a lot of money. All the money's here. Very little's here, okay? Then if I asked you, what age group do you think has more money in a Roth? The baby boomers, the greatest generation? Or do you think it's the younger generation, Generation X and the millennials? Right? It's the millennials have more money here because they've been making contributions to their 401ks and everything else. Like I said, I talked to thousands of people, and almost 70% of them don't even have a Roth, and these are people that are retired or close to retirement. When I talk to younger folks, all of them have all of their savings in a Roth. So two things. One is that most of the money is sitting here, very little sitting here from a percentage of all retirement accounts. So is the IRS going to go here or here? Right? They're going to go here. They asked John Dillinger, why, John, do you rob banks? And what did he say? He said, that's where the money is. That's where the money is. It's here. So what are they doing? They got rid of the stretch IRA. Boom. That's going to blow people up. If I got a lot of money here and I die and it doesn't go to my spouse, that goes to my kids. It could be 5 years where that thing is fully distributed, or 10 years, depending on the beneficiary designation. So they're already starting to attack these things. When you look at if a non-spouse inherits a retirement account, the IRS doesn't even consider it a retirement account. That's why they want to get rid of the stretch altogether. No, the retirement is for the owner. It's not for the child. So they'll probably attack here before here, right? Second is that most of the people that have the money, and they're not going to do this for years because this is the golden goose. It's really good for us, the consumer, right? And it's really good for the IRS right now because why? They get a little bit of tax revenue up front versus having this thing defer. Right? That's why they changed the law on TIPRA in 2005, starting 2010. That now we can convert if your AGI is over $100,000. So what? Good. Now people that have high income can convert. So people are now taking advantage of that. Okay. IRS is happy. It's like finally we get a little bit more tax instead of these people just keep deferring this until we have to mandate it out when you turn 70 and a half or 72. Okay. Most people, right, don't have a lot of money here. It's like the 25, 30% of individuals, that's where all the money is, unfortunately, right? That's where they're going to go after. Now, 30 years from now, they're going to change the law. They're going to say, you know what, this was a really good deal. This Roth IRA it's killing us, killing our balance sheet. Let's change it. But who's in office? Right? The millennials, Generation X. Where's their money? It's in Roth. I don't know. They're going to screw themselves.
You want another question?
I don't care.
Lyle says, while my stocks were down about a month ago, I moved everything from my IRA to my Roth. I think that was a great move since I feel the gain in these stocks in the Roth will increase enough to cover the taxes I will need to pay due to the IRA cash out. I think it did a good thing. Agree?
Agree. Al?
Totally agree. Yeah, that's the best time to do it. I mean, it's hard to market time for sure, but if you can, try to get that money into the Roth while the market's down, get all that future growth in a tax-free environment.
Kevin says, earlier this year, I converted all of my wife's IRA to a Roth IRA so she can do the backdoor conversions. Does she have to do the backdoor Roth contributions before December 31st, or do we have until April 15th for fiscal year 2020?
April 15th. You're making a non-deductible IRA contribution. You have until, if you haven't made one from June, for 2019, we have until July. So just remember, because it's non-deductible, you've already converted all of ours out. Every contribution that you make is non-deductible now, so you have basis in the IRA. So it doesn't matter, then you just convert it. So you can wait till next year to make the contribution for this year. And then you could do two contributions for 20 and 21 next April, and then convert that IRA. They both have basis. There'd be no tax due.
Yeah, we should also, just for people that want to know what we're talking about. So anyone can do a Roth contribution as long as you have earned income, either husband or wife, or if you're single, if you have earned income to cover that. And right now, this year, it's $6,000 per person, or $7,000 if you're 50 and older. Now, for some of you, married couple, for example, if your income is over $194,000, it starts phasing out your ability to do Roth contributions. And once it gets to $204,000, you're not allowed to do a Roth contribution, but you can do an IRA contribution and then turn right around and convert it. So a non-deductible IRA contribution, turn right around and convert it. Basically, it's the same impact as a Roth contribution. You just kind of went the back door. So that's what we're talking about. If your income is low enough, just go ahead and do a regular Roth contribution and you're done with it.
All right, we still have a bunch of questions here. Howard says, I heard if you're in a 401k, there is no required minimum distribution. It's only from an IRA? ?
No, it depends. If you're in a 401k and you're still working, then there's no required distribution until April 1st, the year after you retire. That would be your required beginning date. But if you have a 401k and you are now 72, you absolutely have to take required distribution out of the 401k. So you might have heard if you were still an active participant, you're still working in your 70s, you don't have to take it out of the 401k, just the IRA as you're contributing. But once you do retire, then of course you would have to take a required distribution from the 401k.
Our friend Batman is on the call. He says, could taxpayers still take advantage of deferring capital gains realized from October to December of 2020 until July of 2020?
I thought he was going to start talking about opportunity zones. Or
he does then say into a qualified opportunity zone fund. Yes.
See, I knew.
Yeah, that's where
you got to finish Batman's. I can finish his sentence for him. Al, you want to take a stab at Batman's opportunity zone question?
Yeah, opportunity zones. This is a new thing that was maybe 2-3 years ago, something like that. So the thing is, you could, if you had any kind of capital gain, whether it's from real estate or stock or any asset outside of retirement where you got a capital gain, you could within 6 months invest that gain, not the whole thing, just the gain. You could invest it into a qualified opportunity zone investment, and then end up basically deferring that gain for at the originally 7 years. Now I think it's through year 2026, if I'm not mistaken. And if you hold that investment for at least 5 years, then 10% of that gain goes away. It's tax-free. And if you hold it for 7 years, then another 5% goes away, so 15% tax-free. You do have to pay the tax, though. That 15 or 85% of the gain is taxable in 2026. But the opportunity zone investment itself, actually, any future gain on that is completely tax-free. So I think that's what he's talking about, and it is still available.
All right, and then let's see. We have got Sid says, will you please indicate the expected tax rates may go to? 12% is going to go to what? That's her first question. Then she's got another one.
Sure. If you look here, oops, let me cancel this.
And by the way, what Joe's going to be talking about is current law. So current law, we revert back to the old tax rates in 2026.
So this stays at 10%. Oh, look at that. Oh, that looks good. This 12% turns to 15%.
That's better.
Yeah, it's getting there. This 22 turns to 25. Has anyone ever tried to draw with a mouse? This is not easy. 24% turns to 28%.
In another 40 years, that's what your handwriting is going to look like, Jack.
Right.
I say you are doing a dang good job.
And then 32 goes to 33. And then the 35, it doesn't matter that Big Al's head's there because it doesn't change. That's 35. And then 37 goes to 39.6.
Okay, I take that back. Not such a good job.
So this is where they're going in 2026. So this is your arbitrage. Do you want to pay 12% or 15%? Right. So if I'm at $80,000 of taxable income, this is married. So as a single taxpayer, just cut this in half. Right. If the single brackets are half, if you file head of household, I'm sorry, I don't have those numbers in front of me. 80,000 to 171, right? 22 is what you're paying today. It's going to 25%. 171 to 326, paying 24 versus 28. If you're also in this, what also reaches, which is going to come back, is called AMT tax. So AMT is an alternative tax, and it's basically kind of almost like a flat tax, but your effective rate goes to 35%, okay? So you just have to take a look. This is law. This is where they're going. Here's where we're at. So it could be a good idea potentially to look at, buying that tax rate a little bit cheaper.
All right. Sid's second question is, my traditional IRA at $4 million now is growing faster than I can convert it to Roth. Any help here? I guess that's a good thing.
That's a very good thing, Sid. Congrats.
By the way, you can convert the whole thing. We're not suggesting that, but there's no limits on how much you convert. So you could, if you want to, go for the whole $4 million.
Don't do that. Don't do that. Like, just look at the brackets. Is that all right? Well, it depends on how much that he's. I don't know how old Sid is, and I'm not sure how. I know he's got $4 million now. Thanks, Sid. It's like you got to do some forecasting here. What target rate of return? What's the assumption that you're going to make on that money? And then when do you turn 72? And then what is the required distribution going to be at age 72? So let's say he's 62, that $4 million, let's just assume over a 10-year time period, it doubles. And now it's at $8 million because you're not taking any dollars from the overall portfolio. You're living off a pension, Social Security, maybe you got real estate income, whatever the case may be. So now you got $8 million. Your required distribution at 72 is going to be roughly 4%. So $320 some odd $1,000. So then I go back and look at, all right, well, at $320,000, what tax bracket am I going to be in? And then you look here, it's like, well, 326 is 32%, right? 24, but these are going up. This is going to be 28, right? And then inflation's going to adjust these. So you're kind of like in this zone here with between 32 and 24, right? Just that's what your tax rate's going to be. And where do you think they're going to attack? The higher tax rate people are probably going to see larger increases there. So then that's kind of the game you play. Like, all right, now I'm going to convert to the top of the 32% tax bracket. Right? But then you have to look is, all right, do I have enough non-qualified to pay the tax? Or at the end of the day, congrats, there is no way around the tax here, right? There's no way around the tax.
Joe, I think it's important to sort of make sure that we talk about tax diversification. You don't need to convert everything. And in fact, if you convert everything, you're probably in a higher bracket than you're going to be in retirement, because if you convert everything, you won't have a required minimum distribution. Maybe it's only Social Security and a little bit of other income. So you don't want to pay tax in the 37% bracket if you're going to end up in a 12% bracket. In other words, Roth conversion today in a 37% bracket if you're going to retire in a much lower bracket. So that's why you have to do a little bit of planning to figure out what's the right bracket for you to convert in. And so going back to your example of 4 million, I was making a joke. You don't want to convert the whole 4 million because of what I just said. You'll be in too high of a tax bracket. But the point is you can. There are no limits on how much you can convert. You just need to be a little bit smart on your tax bracket today versus the future.
Cool. Well, that's all we got. Andi, do we have any gifts, partying gifts for our lovely viewers today?
We do. I have just put that up on screen. We are offering you a tax reduction package. Now, you can't control the markets or legislation, but armed with the right information like you get from Your Money, Your Wealth, you can control how much you pay in taxes. So this tax reduction package, first, is a tax reduction analysis. Normally, Pure Financial Advisors charges $250 an hour for this, but because of COVID-19 and because of the unique circumstances, we are offering this to you for free. Along with it comes our tax planning guide.
Except for Batman. Batman's got to pay.
I'm sorry?
Except for Batman.
Batman's got to pay, yes.
A lot of you people, nothing for free.
Free gifts if you do actually schedule your tax reduction analysis. You get the tax planning guide, the tax checklist, and also our Executive Vice President and Director of Research, Brian Perry, CFP, CFA, has written an ebook called Retirement Revamp, Financial Planning in Times of Crisis. We will give that to you for free as well. Once you click on that link, you can fill out your information here. And then if you know when you want to come in for your tax reduction analysis, you can just schedule it on the calendar right there. And find out exactly where you stand tax-wise. And now we're all back. And so, yes, just click that button to schedule your tax reduction analysis and get the tax planning guide, the tax checklist, and the ebook for free. And thank you all so much for joining us, and thank you for all of your questions. And
I guess, keep the questions, easy for me to say, keep the questions coming in. You guys are the ones that kind of make our show, so we really appreciate you, spending an hour with us each week listening to the podcast, and then now hopefully spend another half an hour with us watching the really cheesy television program. But we're here to help. Any questions you guys have, they're great. We love the comments. We love building the relationships with you guys. So the side comments are really hilarious, and we enjoy them immensely. So that's all I got. Al, any parting words?
No, I thought this was a lot of fun. Again, I look forward to doing this yet another time.
Yeah, it's probably not going to be for a couple months, Al.
When we do schedule another one, we will actually be sending that out to the newsletter. So make sure that you go to the podcast show notes and click on that link that says subscribe to our newsletter so that you will be notified when we do have another one, assuming that we can ever get Joe in front of a camera again. And in the meantime, if you have any questions, email info@purefinancial.com, call 888-FEE-ONLY. That's 888-333-6659. And don't forget to listen to the Your Money, Your Wealth podcast to hear more of these crazy gentlemen every week. Thank you, guys.
Cool. Have a good day, everyone.
Bye-bye.